Market update for Q4 of 2025. So it's September 5th, 2025, and I'm going to cover a macro market overview to get everyone up to date. I'll go over some bear and bull arguments, and then we'll try to answer some questions such as, have asset prices topped already? Are we in a bubble? Etc. Finally, I'll make some Q4 predictions, go over what to watch for in September, and then update my personal portfolio update and plans. Some market overview here. This is the S&P 500. It's a weekly chart. You can see it goes back to 2017. The COVID low of 2186 on the S&P was in 2020, and then we've come all the way up. Most recently we've hit around 6470, and we're getting close to the 6500 to 7000 range that I had predicted earlier on. The big news is the April sell-off to 4800 and a very sharp V-shaped recovery from the 4800 in April all the way back up to 6500. So quite impressive recovery there. The Bitcoin US dollar chart, we're at about 109, 110,000 today. And you can see this is a monthly chart. We'd hit about 123,000 and then sold down. I'm pretty confident we're going to move at least one more leg higher into that 125 to 175,000 range. Most likely, if we break 123, we'll go to at least around 140. So by December, 140 to 175,000 US dollar seems to be a decent range we could hit. So once again, let's start with the bear arguments, and then we'll go to the bull arguments. So the top bear arguments I'm hearing on X and Twitter and Legacy Financial News, etc. The bears are saying that, look, almost all major assets are at all-time highs. Gold's at all-time highs, Bitcoin and crypto at all-time highs, the S&P all-time highs, and international stock markets in Europe, UK, Canada, Australia also all-time highs. Silver as well, breaking out recently. So everything's quite high, and this is a bubble across, I guess, most of these asset classes. US stocks are overvalued historically. We'll look at PE values later on. They say margin accounts are too high, borrowed money in trading accounts by retail investors. They'll also say, look, we've had a 3-year bull run since 2022, and we've had 15 years of relative good markets since 2009, and it's time for a crash, and that markets can't stay up forever. Bears are also pointing to the job market weakening. There's been some job revisions in the last few months downwards. They say U.S. real estate prices are too high and will crash. They keep saying a recession is coming. AI is in a bubble. Inflation will persist and therefore not allow Powell to keep cutting rates. Government debts around the world are unsustainable. There are geopolitical risks that continue. The Russia-Ukraine war has not been settled since Trump joined. The Trump administration joined. Israel and Iran are still having trouble. And the Trump tariffs are still creating uncertainty. And so all of these together, they're saying, look, 6,500 is the top, and we're going to sell off here, and we can't stay at these lofty numbers forever. Going deeper into the bear arguments, we'll start here with the AAII Investor Sentiment Survey, and you can see that as of August 27th, you have 39.4% of those polled being bearish and 26% neutral. So if you combine these numbers, we're at about 66% of investors are not bullish, and that's an interesting statistic that supports bear arguments. A big part of this bearishness is certainly because of recent jobs data. So in July, there were only 73,000 jobs added, which was much lower than expected. So if we're looking at US added jobs since April, we had revisions down in May and June, very low, and then July was low. So you can see the last 3 to 4 months have had weak job results. And of course, bears will argue that as people start losing their jobs, they'll start defaulting on mortgages, they'll start spending less, and sentiment in the job market greatly damages retail consumer sentiment. And this is the beginning of a cycle that will carry down asset prices. And the August US job data just came in this morning, and the bears are right that the job weakness is continuing. So there was only 22,000 jobs added in August, which is much lower than the 75,000 that was predicted. Additionally, there was revision downward for June. So you can see the red square showing a loss of 13,000 jobs in June. That's the first time we've had a declared loss on a monthly basis for several years. So the job market is much weaker in the last 4 months. And of course, the bears are going to jump on this and say we're at the beginning of a recession because of this. Markets, stock markets and crypto initially rallied on this information because this confirms almost certainly that we'll get a rate cut in September. Sticking with the bearish side of this argument, it could be the beginning of job weakness, and it might be that this carries into consumer sentiment and retail spending going down. But we still haven't seen corporate profits affected negatively. And again, we could get revisions that some of this data gets stronger later. So we could still have positive job results in Q4, which would be very bullish. In any case, August was not good for the bull argument. Bears have been saying that the US price earning ratios are at historically high prices, and they are. You can see we're at 29.96, and we are above the typical valuations of US stocks. And once again, the bears will say this is not sustainable and we need to revert to the mean, and it's just historically an outlier to be at this expensive level of PE prices. University of Michigan consumer sentiment has released numbers recently very low in the 60 range at the far right. You can see, and once again, this goes back to 1980. It's been as high as 110, and we're way off that. So historically, U.S. consumer sentiment is low, according to the University of Michigan. Another data point to support the bears. Retail investor margin debt in their brokerage accounts has reached an all-time high of over $1 trillion, and bears will say this shows leverage with the margin amount is the amount borrowed within the accounts, which suggests leverage in those accounts, what we call margin debt, and this is very high. Now in nominal terms it's a new all-time high. As a percentage of other amounts of money, it may not be, so I can look at this a little bit later. I'm not sure this is really that bearish, but in any case, this is something that's been pointed out in the Twitter X world, that margin debt is historically at a new high level. Moving to bull arguments. I'll cover quite a few slides here. We'll look at US GDP growth. We'll look at sentiment, things like tariff searches and whether that's still a big fear in the market, corporate profits, the US unemployment rate, inflation, US housing prices, We'll look at high yield credit spreads and whether this is indicating a risky market or a safer market. We'll talk about the Fed cuts on September 17th and some recent market performance in August with stocks and how that relates to predictions of the future based on historical data. So this is US real GDP. So this is inflation adjusted quarterly change in GDP. And you can see we've been positive the whole way through with one exception, Q1 of this year, the red bar at the bottom. But you can see we've had somewhere around 2.5 to 3.5% GDP growth since Q2 of 2022. So the end of 2022, we had 2 quarters averaging over 3%. 2023, we hit as high as over 4% 1 quarter, and it's been quite steady growth. 3.5% is not super growth, but when you consider the size of the U.S. economy, it is significant. It's a lot of growth in productivity. And so, of course, what we call a recession is typically 2 quarters of negative GDP growth. But after Q1 was negative, the red bar, we had a very strong bounce in Q2 of over 3%. So no recession so far. And again, modest growth, but on the level of an American economy that is so enormous, you still have massive amounts of wealth being created, and that's being represented in corporate profits. So those people saying that these numbers are fixed or somehow being lied about, you hear this a lot about job reports too, that the government just lies about statistics. Well, with GDP, it's a little bit harder to hide the number in the sense that the GDP numbers show up in corporate profits one way or another, and the corporate profits are audited, and it's illegal to fake those. And so when you see these numbers combined, you can almost certainly, you can be assured that there is growth in the U.S. economy. Companies are making money and growing, and this is all positive for risk assets and asset prices. We are now well into Q3 of 2025, and the Atlanta Fed GDP Now website just updated as of September 2nd, and they have Q3 real GDP at 3%. So this would be another very decent quarter of growth and ensure that there is no recession, at least immediately in front of us. So we're projecting 3% for Q3, which is positive. Looking further back, all the way to 1950, this is US real GDP for a long period of time, and you can see the only sort of dip was in 2020 when you had the COVID crisis and the entire world shut down, but we've had steady real GDP growth for 75 years. And again, you have an economy that's larger and larger, and so small percentages mean billions, trillions of dollars of wealth and growth being created. So this is very supportive of corporate profits and a long-term increase in risk asset prices. There are many reasons why US GDP keeps growing, but one of the simplest ones to follow is simply that the total population of the US keeps growing. You can see this chart from 1955 to present. The US population has grown steadily and matches very closely to the growth in real GDP. So we're currently at over 343 million US citizens. This is in a vibrant, very pro-business nation, which has economies of scale and a lot of wealth. It's about 25% of all wealth in the world is held by US citizens, and then you have a rising population and immigration into that, and it's why assets are bid up, why real estate prices go up, and why shares and other risk assets go up. A large bear argument in April was the Trump tariff scare, which caused a sell-off of over 20% in stocks. This is Google Trends data showing the word tariff being searched on Google, and you can see the peak was in April of 2025, and it's fallen off back to almost the same level it was before Trump was in office. And so it seems like the tariff scare is fading, and it's faded. Again, this was a major argument in April for why the bears said we were going to have a major recession or an economic breakdown, was the fear of Trump. But these fears have faded, like most fears we've had in the last 3 years. They've faded relatively quickly, and stocks have rebounded. Going back to our AAII investor sentiment survey that we looked at before, when you're saying that 39.4% of investors are bearish, it's kind of hard to believe that we're in a major bubble or a top necessarily. Certainly there are strong bear arguments, and assets are expensive, but it's not typical of a bubble. We can talk about this a bit later, but it's not typical of a bubble to have 66% of retail investors either negative or neutral. And so we're hardly in a euphoric stage right now in terms of investor sentiment, and I would argue this is a bullish factor rather than a bearish one. We're not seeing signals in my mind of euphoric retail sentiment, and so it means there's a good chance we do go higher, or at least are at the very beginning of any sort of bubble that might be forming. U.S. corporate profits are obviously the easiest way to justify a continuing bull market. You can see the chart is up and to the right. Especially the S&P 500, these companies are making money, a large percentage of them. If anything, costs are falling as there are less hires, and with the advent of AI, there's a lot of predictions that corporate profits will continue, that margins will stay strong, and especially the big tech companies will be able to increase revenue while simultaneously reducing costs of things like labor. U.S. house prices in the U.S. continue to rise. You can see all of these charts are from the bottom left to the top right. And U.S. prices, of course, they capture inflation, and so these are nominal prices, and you could argue that inflation adjusted, that's not as attractive, but in any case, it creates a wealth effect, and people that own houses, typically that's their number one investment, and as these numbers rise, or especially don't fall, the mood of these investors who also own things like stocks and cryptocurrency and other gold, their mood is buoyed and supported, and they are confident as long as these prices stay at or higher than current levels. This chart shows the high yield credit spreads. So it's the difference that is demanded in the market for risky junk bonds versus very safe U.S. Treasuries. And so as the credit spreads are lower, this indicates global markets are less risky of defaults. Bond traders are notoriously known to be very analytical, very smart, and risk averse. And what they're saying with these yield spreads is that risk in the market is very low. Even junk bonds will be able to pay the borrower back in the short to medium term, let's say, and that they do not see significant risk in the markets of a breakdown or a major crash. U.S. inflation going back to 1965, all urban consumers in the U.S., these are averages, we're at 2.7%. You hear a lot about inflation being resurgent and too high, and you hear people saying, well, the Fed's target is 2%, and so 2.7% or 3% is not there, and therefore they can't cut rates. I think this chart shows that we're actually getting very close to what is a typical historical lower rate at 2.7%. And the fact is, Powell is signaling rate cuts, despite whether you think this is high or low. But I think the historical chart gives some insight. We also hear from the bears that the job market is weakening. That said, we are still at a very low 4.2% unemployment rate, and that it has not spiked as the bears have predicted. So we're at 4.2%. That could rise, but historically very low. And perhaps the job market is not growing, but it's not shrinking as well. As mentioned earlier, we just got the August jobs numbers, and as mentioned, that's only 22,000 jobs in August, which is very, very low and below expectations, and then revisions downward for June, which had negative jobs. So the bullish side of this argument is that this secures an interest rate cut of at least a quarter point in September 17th, and you could even get a half 0.5 cut in September. So in that sense, the markets might like this. What we don't want to see is further job deterioration in Q4. So if this trend continues, it's looking not good. However, if we can find a balance where there aren't job losses, but there's just very slow growth, and yet rates fall, that could be a sort of Goldilocks scenario or sweet spot, and that the markets would like that. Also, this will bring inflation down. If the job market is weaker, you'll have downward pressure on inflation. Again, the Fed will like that and let them cut rates more. So let's see what happens. But currently, the market is kind of neutral on this data. They like that interest rates are going to come down, and so markets were up originally on Friday, or rather on Thursday, and then down a little bit. So they're sort of neutral whether this could be good or bad for asset prices. Corporate profits will be the litmus test in Q3 and Q4 to see if companies are still making money, even though some people are suffering with job losses. Rate cuts are likely coming. This is the predictor for the 17th of September, the next Fed meeting. We have an 87% chance that Jerome Powell will cut a quarter point. He was recently very dovish in his speech, mentioning that policy will be changing. And my opinion is that unless we have some very major positive news in the U.S. economy, inflationary, growth-oriented positive news, unless that happens, we're definitely getting a cut. The other thing is, once we get one cut, we might get 2 or 3 or 4. And the trend tends to be once they start cutting, they cut more. But we'll have to wait and see. Definitely the Fed rate is a little bit too high given inflation rate. So this is the top 10 S&P 500 returns from June to August since 1950. And they indicate that when we've had a very strong summer, June to August, that we've had better results for the rest of the year. September maybe not so much, but definitely till December. So it's showing a very high return when you've had a summer like we just had. In 2025, we just had 9.3% from June to August. And this suggests that we're probably going higher in the next quarter. August 22nd could go down as a very bullish day according to this data. And you can see this is from Carson Group, by the way, and that it suggests, it gives examples 1982, 1987, 2007, all the way down where you had over 90% of the New York Stock Exchange advancing, and volume. So you have on August 22nd, you had 90% advancers and 91% volume. It then shows that over the next 1 month, 3 months, 6 months, and 12 months, it's almost always green. And you have averages of 5, 11, 16, and 23% within 12 months. So again, this is correlated data when this sort of positive moves have happened in the past in the summer. In the next chart, you can see this is instances where the S&P 500 had 75% of its stocks exceed the 200-day moving average. So the green arrows are showing the cases where this happened. And then you can see after the green arrows, markets go higher. You can see if you look really closely, after each green arrow, typically you see markets go higher over the next 12 months. So another indication of bullish correlation with what's happened this summer. A final bear talking point that's been very common for the last couple years is that yes, the S&P is going higher, but it's only because of the Mag 7 big tech stocks, and that they're carrying all of the weight, so that there's no breadth, there's no volume to the number of companies that are going up in value. It seems like this is not true either, that we are getting quite good. You can see 52% of stocks are advancing this year. And we've had 23, 24, and 25 all had over 50% of stocks advancing. So it's not just the Mag 7, at least not anymore. And that we're getting a lot of data saying that this is a major move across all risk assets that are going up. And it's not just a few carrying the load. And finally, we can look at geopolitical risks and the Trump administration. So some main themes that the bears have outlined as risks to prices are the Russia-Ukraine war, Israel and Iran impacting oil prices, Trump administration issues such as the tariff policies creating uncertainty and slowing down global trade. So let's look a bit more closely at whether these are still risks and if they ever were. Quickly on Russia-Ukraine, I mean, the war's been on for several years, and markets have gone through that and been strong, and so it seems to be a non-issue. The biggest risk, I think, has been the Israel-Iran breakout, where they had missiles fired in both directions. It started with a war of words, then some very limited strategic firing, and finally what you could call a full-scale missile volley on both sides, hitting both Israel and Iran. Several Iranian leaders and scientists were killed, and finally the US dropped a major bomb on one of their facilities, one of their nuclear facilities. So by most measurements, this was the worst case scenario coming true. What the bears said could happen and would be a disaster actually did happen. You had a kinetic war, you had bombing, and you even had the US involved. And then you say, well, what's happened? Markets hardly even sold off during that, and Iran has been very quiet. So obviously I'm not an expert on the topic, but it does seem that Iran has chosen to lie down in many respects and not escalate the problem. Certainly there could be some risks down the road, but as we stand, this turned out to be a non-issue to the extent that it has not interrupted global markets. Oil prices are down, you can see, since 2022. We're hitting about $63. And this is despite all of this apparent risk to oil prices, people saying the Strait of Hormuz is going to be closed and this will cause a spike in oil prices, and it just hasn't happened. The Genius Act has been passed through the Trump administration, and the main takeaway is it's going to be allowing stable coins to be legal and promoted, and we're going to see a very large increase in banks being connected to this this network and this payment rail. And a lot of this is going to take over in terms of ways of making payments. And of course, it increases the network effect of things like Bitcoin and Ethereum. So USDC through Circle and USDT will get a lot more liquidity. It's probably bullish for the US dollar, medium long term. But in the short term, yes, it's bullish for crypto. It also indicates the Trump's administration's pro-tech and pro-big business and pro-innovation policies. And so this puts a lot of air in the sails of asset prices moving forward. One more thing is that midterm elections are in 2026, and Trump's already come through with some more defensive anti-trade policies like the tariffs to protect the American worker. But I think the other side of this is he's going to try and pump the US economy so that people are happier and that the Republicans can win in the midterms. So look for tax cuts and more pro-business policies from Trump and company. Video conclusions, and these predictions are only for the next 4 months. I'm still bullish for Q4. So despite some legitimate concerns about everything being too expensive, I think geopolitical risks are lower. The Trump administration is supportive of risk assets, including crypto. Are we in a bubble? No, I don't think so. But could we be in the very early stages of a bubble? Yes, possibly. But you have to think, bubbles typically don't have the following types of characteristics. They don't have retail sentiment either bearish or neutral at 66%. Usually bubbles have most of the market euphoric and saying things like stocks will never crash. But we have the opposite of that. We have a lot of people calling for a crash. Bubbles also typically don't survive two major sell-offs like the April 2025 tariff scare. We dropped 25% on 20%. And in November 2021, we had an inflation scare where we dropped 27%. And even within the last 5 years, we had the COVID sell-off of minus 34%. So we've had 3 major sell-offs in 5 years. This is not characteristic of a bubble because usually when you have a major sell-off, it pops the bubble. But we've had all of these medium-term crashes be bought by investors. Okay, so why are prices so high? We've had the easy money policy since COVID and the money printing. Housing prices have held up and risen for multiple reasons, larger population and government spending. US boomers are still the richest cohort in history. We've had a tech boom for 15 years and now an additional AI boom for the last 2 years, which is keeping corporate spending up. Watch for job losses and resurgent inflation. So price predictions, I see the S&P 500 going up into the 6,500 to 7,000 range. That would be about 5 to 6% up from here to hit 7,000. Bitcoin 140,000 to 175K by December. Ethereum and Solana should be at or above new all-time highs, and they will drag up the Ethereum treasury companies like SBET. They'll go much higher. There'll be a multiple of the ETH and Solana increase. MicroStrategy will follow Bitcoin up to the 550 to 750 US range. I'm a little bit more cautious on MicroStrategy because of the big sell-off, but it will follow Bitcoin up. Palantir continues to be a winner. It should go somewhere between 160 and 180 US dollars by December. Tesla should be a bit higher. We're waiting for the robotics and AI side of the business to grow. Sterling Infrastructure is one of my non-tech companies. They've been a big winner for many years now for me though, and it should hit 300 USD. And then my only short position is D-Wave, which is QBTS, and D-Wave is a quantum stock. They're valued at around $5 billion, and yet they almost have no revenue. So it's going up with all the liquidity and the hype around quantum, but I think it's an empty company with very little chance of actually finding products that the market will buy. So I'm short. I got in around $17 and it's around 15.5, so I'm about even. But definitely if we have a big market sell-off, I think the quantum stocks will sell off much more, and so it's just a small short position I have. So my action plan going into Q4 is to be selling. I will be selling into the above numbers. As we go into these higher numbers, I'll be selling about 15 to 20% of my portfolio. The reason for this is mostly a personal situation. I am in profits in all of these positions and looking to rebalance. I'm also selling out of the money covered calls for MicroStrategy and Palantir, which are producing some income. If the US economic data stays resilient, if the job market rebounds or stays strong, and if inflation stays flat, and if rate cuts continue, we could have another good year in 2026. So I'll come back with another video towards the end of the year or in January to update. And I'm staying bullish for the most part as long as the data supports that. Thanks again for listening. You can find me on X, Twitter, at Gresham's Law 7.